Stay with us, Steve. Let's dive a little deeper into the president's efforts to reshape the economy. Joining me now, Don Schneider is deputy head of U.S. policy at Piper Sandler, and Mark Goldwine is senior policy director at the Committee for a Responsible Budget. I'll let each of you, gentlemen, and welcome, maybe handle this, Don, to you first. Where do you see, if anywhere, an economic emergency?
I think that would be on the fiscal front. The stance of our deficit, about 6.5% of GDP, is totally out of whack with where it should be, given the stance of our economy right now. So I agree with Steve's framing that I think, and how I would think about the kind of Trump economy and what his policies are: tax, trade, fiscal, and regulation and immigration.
Yeah.
On all those fronts, I think they kind of wash out to a more neutral position. I have a relatively more optimistic view on the deficit. I mean, we are headed structurally to 7.5% of GDP deficits by the end of Trump's term. I think when you start factoring in the policies that will be necessary, spending cuts, and of course tariffs that will be in the mix, we might be able to keep the deficit at, say, 6.5% of GDP. So that's not great, but I think it's better than the counterfactual.
Yeah, I think it's actually, normally we'd say that's an emergency, and right now that's the best case outcome. But Mark, what would you say as you look around, if anywhere, where do you see an economic emergency?
Yeah, Don's right, but it's not just the fiscal itself. It's the economic effects, the fact that inflation still isn't fully under control, and that interest rates are in the 4s and 5s, for mortgage even 7%. And so if we don't get our fiscal house in order, it's going to be tough to get either inflation or interest rates down.
So you both agree then. Steve, I'll turn to you, and maybe that helps explain, if the emergency is really on the deficit piece, why we're seeing such urgency from the president to look at revenue sources along with spending cuts to try to close it.
Well, the trouble with that is it sounds like both of your guests, Kelly, kind of agree. The idea is that the president is not strictly oriented towards solving the deficit problem. Now, it is a bit of hypocrisy from the Democratic side to argue, oh, President Trump has to solve the deficit problem. Well, that was true under Biden, and he didn't do it. And now it's unfortunately going to be more true. My concern, Kelly, is the way that these things might offset. But there's no guarantee either that the magnitude of either side is going to work or they even get enacted. For example, we talked, I think it was last week, Kelly, about how hard deregulation can end up being. Kevin Warsh wrote about this in the Wall Street Journal last week. But the notion of deregulation as a disinflationary impulse is a new idea. It's an interesting idea, but it's a new one we haven't seen yet. The tariffs, well, we've talked about the idea that tariffs could well be a one-time rise in the price level. But I talked to Stephen Stanley from Santander, and he says, well, you know, in this environment, just because you have a 10% tariff doesn't mean you can't raise prices by 15%. So there's all those concerns, I think, some well-oriented or well-focused ideas, but if they offset, they better be passed in an offsetting way.
If I could move along, gentlemen, to the issue of manufacturing, Don, I think certainly the president's team would say that there's a national emergency there. They kind of view that it's shriveled so much because of the strength of the dollar and so forth that it almost brings into questions about national security. You know, if we really need, look at what happened when we needed to send artillery to Ukraine and we literally couldn't do it that quickly, or the pandemic hits and we don't have the domestic manufacturing to rely upon. So from that point of view, do you agree that that might be an emergency? And if so, what would be the best remedy to fix it?
Yeah, I think, you know, tariffs are ultimately growth negative. Those are taxes. They're borne by individuals and businesses. They can, of course, have some sectoral implications. They can act as a subsidy to domestic manufacturing, though, of course, if their input costs go up, it isn't net beneficial for growth. There are two things that I'd be focused on. Number one, Republicans are focused. They're thinking about adding $120 billion, maybe more, for defense spending. A lot of that money would go to revive the defense industrial base. And also, the Republicans are going to be looking for something pro-growth to add to the tax bill. One of those ideas, for example, could be full expensing for structures. That's an idea that I think would be more constructive than Trump's idea for a 15% rate just for domestic manufacturing. But those sorts of ideas, I think, can help with the state of U.S. manufacturing.
Mark, same question. We know that even as we're watching decent economic numbers, the manufacturing data still remain in basically contraction. We lost manufacturing jobs last month. How do you view that?
Yeah, look, this is a long-term trend driven by trade patterns that makes us wealthy on so many other fronts. And so I think what you want is overall strong growth. And the two things they should be looking at is, one, a stable neutral tax code. Right, a stable neutral tax code will promote more of everything and lower interest rates. And that gets back to this deficit reduction. If companies can borrow more easily, they can produce more stuff.
Mark, is there anywhere else? So we've kind of talked about the deficit. We've talked about manufacturing. Is there anywhere else, and you mentioned inflation, anywhere else you'd say that we face an economic emergency, or that you think is a kind of an area where we really are playing from strength right now?
Yeah, well, it's not a near-term economic emergency, but it's coming. Our major trust funds for Social Security and Medicare are only a few years from insolvency. And I understand that's not a tomorrow problem, but it's 8 years away in 2033 when today's youngest retirees turn 70. And if we don't fix those problems, there's an across-the-board cut coming. So I would just be focusing on those pretty darn soon.
Yeah, not without.